Right now, I'm going to attempt to dissect the insane saga of the GameStop stock that's been playing out over the past few weeks, making ordinary people millionaires and taking down billion-dollar hedge funds in the process. This is a bit of business. Real quick before we get into it, if you could please leave a quick like on the video and subscribe for more business stories, it truly does mean a lot to me. Also, a quick disclaimer, I am by no means an expert on stocks and this is not investment advice. Let's get into it. It's no secret that GameStop hasn't been a great company in a long time. They've become less and less relevant and announced as recently as December that they'd close 1,000 stores by the end of March. However, their stock has a different story. On January 11th, it was trading at $20 a share, and on January 27th, it climbed past $400. Contrary to popular belief, the start of the frenzy can be traced all the way back to September of 2020. That's when Ryan Cohen, founder and CEO of the e-commerce pet company Chewy, bought a 10% stake in GameStop through his investment firm RC Ventures LLC. Cohen sold Chewy to PetSmart in 2017 for $3.35 billion. The GameStop stock started climbing due to Cohen's experience and confidence in the company, and it doubled to about $10 a share between August and September. And on November 16th, 2020, RC Ventures sent a pretty strongly worded letter to GameStop's board of directors outlining the flaws in their strategy. This one paragraph that was both bolded and underlined in the letter pretty much sums it up. GameStop's leadership should immediately conduct a strategic review of the business and share a credible plan for seizing the tremendous opportunities in the rapidly growing gaming sector. GameStop needs to evolve into a technology company that delights gamers and delivers exceptional digital experiences, not remain a video game retailer that over-prioritizes its brick-and-mortar footprint and stumbles around the online ecosystem.
Boom. Roasted.
While the basis of the letter pretty much just tears down GameStop as a whole, the board of directors must have agreed with Cohen because on January 11th, he was offered a seat on the board, and their stock doubled from $20 a share to $40 a share in the days following that announcement. Now, not everything was positive. At this point, the GameStop stopped. Holy shit. Now, not everything was looking up. The GameStop stock was one of the most heavily shorted stocks on the market, meaning that huge hedge funds were wagering billions of dollars that GameStop would fail as a company. And little did they know at this point that their bets on GameStop failing would be one of the very reasons that it succeeds. This is when the absolute legends from the Reddit thread that you've probably already heard of, r/Wall Street Bets, came into the equation. r/Wall Street Bets started in 2012 by Jamie Rogozinski. Jamie is a 39-year-old IT consultant living in Mexico City with his wife and kids. He started r/Wall Street Bets for investors to share advice that were willing to treat the stock market more like gambling with the hopes to make it big or lose it all. They grew to 1 million members in March of 2020 during the sell-off of stocks spurred by COVID and have since grown to over 7 million members in the last few weeks. While r/Wall Street Bets was the rocket used to take GameStop to the moon, Keith Gill, a 34-year-old marketer from Massachusetts, was steering it. He started his investments into GameStop in June of 2019 because he believed the stock was highly undervalued. Gill started posting what he coined GameStop YOLO updates to r/Wall Street Bets starting over a year ago. He reportedly bought $53,000 in call options in June of 2019. Now, every time Keith Gill would post a GameStop YOLO update, he would get around 5,000 to 7,000 upvotes. However, his update on January 13th got over 49,000 updates after he made over 1,000% in the stock market, gaining over $2.7 million in a single day because of GameStop. And like I said earlier, GameStop was still one of the most shorted stocks on the market. However, the people shorting stocks typically aren't your average Joe. It's huge hedge funds that are worth billions of dollars that end up making all of the money if the stock goes down. You see, if you're shorting a stock and it goes up, you still have to return the shares of stock that you borrowed. However, you're forced to pay significantly more money for that share than what you borrowed it for. When Wall Street Bets learned that they could band together to inflate the price of the GameStop stock, cause hedge funds to lose a ton of money, and then reap massive gains when those hedge funds had to buy their shares back at a higher price, they waged war. The most prominent name that retail investors were trying to take down is Melvin Capital. Gabe Plotkin, who started Melvin Capital, once stated, "We have a lot of analysts, we require a lot out of them. The team has modeled over 500 companies in significant detail, while a data science group reads into trends." Now, the one trend that they were obviously not looking into was a large group of retail investors that were sick and tired of hedge funds having so much pull in the market. The rise of the GameStop stock was incredible. It went from $43 a share on January 21st to over $400 a share on January 27th. Fueled by Reddit, TikTok, and Discord, and the second richest man in the world, Elon Musk, who somehow manages to blend in with the average investor as he joined in on Discord conversations and tweeted GameStonk on January 26, propelling the GameStop stock even higher. Elon has had his own bouts with Melvin Capital as they were one of the most prominent short sellers of Tesla. He sold Tesla shorts for $69.420 when he finally defeated them, and now he was able to throw one last punch at his doubters. It's reported that hedge funds have already lost nearly $20 billion as of Friday, January 29. And we're not done yet. The hedge funds are trying pretty much any way possible to make this out to be anything but legal. Their arguments are generally stemming from the fact that these retail investors are buying the GameStop stock not because they think it's a great company, but with malicious intent to attack them personally. Which is probably somewhat true, but not illegal. Regardless, on Thursday, January 28th, Robinhood and other trading platforms stopped people from buying shares of GameStop and other highly shorted stocks that were popping up as people tried to find the next GameStop. They allowed people to only sell their open positions, which caused stocks like GameStop to plummet from upwards of $400 to $128 a share. Normal retail investors lost millions of dollars as people panic sold their stocks, and the big hedge funds were able to make some of their money back. It gets really interesting when you look at the relationships that these large companies have on the back end. It's important to note that Robinhood doesn't actually make stock transactions, they just facilitate them. After you place an order on Robinhood, it gets routed to a third party to execute. Over half of Robinhood's orders get routed to a company called Citadel. Citadel infused $2 billion of cash into Melvin Capital to help alleviate the losses they've taken on GameStop. Many people have speculated that Robinhood was pressured into restricting trades on these stocks by Citadel because Robinhood needs them if they want to continue operating successfully. That way, the stocks would be forced down and Melvin Capital and Citadel would both stand to make money. However, both Robinhood and Citadel have denied these claims. Since allowing traders to buy a certain number of GameStop stock again, it rose 70% on Friday, January 29th to close at $312 a share. Robinhood has already had dozens of class action lawsuits filed against them in the days after the restrictions. However, it's been stated that in Robinhood's user agreement, it states that they may at any time in its sole discretion and without prior notice to me prohibit or restrict my ability to trade securities. And everyone on Robinhood has hit the button to accept those terms. Now it's going to be extremely interesting to see how the rest of this story plays out as the GameStop stock still sits at over $300 a share. And the man who spurred it all, Keith Gill, now sits on $31,470,000 in profit. Have I mentioned that the GameStop stock is impossible to say 5 times fast? Thanks for watching, and I'll see you next week.